Hello, and thank you for having me. I am here to talk today about the ugly truth about audits. So, I'm going to kind of discuss with you today several things in regards to IRS examinations, but I'm going to start just by giving some details of what is an IRS audit and discuss what are some reasons why individuals do get selected for an IRS tax examination. Then want to provide some details of, okay, what are some key things that you want to keep in mind whenever you're going through an IRS examination process. And then I'll end with a case study of a client we recently represented, the details of their IRS audit, and hopefully help apply some of these things that we go over today. So have a lot to discuss, so I'm just going to jump right in. First of all, just in general, what is an IRS audit? An IRS audit is an examination. It's a review of an organization or individual's accounts and financial information to ensure that information is reported correctly according to the tax laws and to verify the reported amount of tax is correct. I don't know how many of you have had a client who received a tax notice from the IRS in a panic because they were, received a letter that says, hey, you need to be present for this meeting to review your 2019 tax return, whatever it may be. But it's definitely intimidating for clients. It's scary. They aren't used to hearing from the IRS, and nobody wants to hear from the IRS, right? So there's definitely things that I want to make sure through this time that we have together that you understand need to be considered and on the priority list whenever you have a client that receives a notice for an IRS audit. So kind of going forward, the IRS, they do use random selection and computer screening as well as related examinations to select an organization or individual for an audit. So one thing to consider if a client is selected, say for a business return, it is possible that the IRS, if it's a flow-through entity, could consider opening up that audit of the personal return if they feel like there's enough discrepancies on what they're reviewing for the business. So whenever it says related, it could be something in regards to that. And these can be random, but they utilize certain calculations, standards for industries, for example, on business returns to automatically select individual taxpayers and businesses for examinations. Kind of going into the IRS audit rates. So each year, once data is really finalized and formal for a certain audit period, the IRS will release their audit rate, like their tax table for, okay, how many of these audits were selected, in each different category. So for instance, these numbers representing the 2.55% for no adjusted gross income. These categories you see, what they mean is that in that section of income, AGI, that's the percentage of the total of those types of returns that were selected for an audit in 2017. This is 2017 specifically. So it doesn't necessarily mean overall that income over $10 million was the highest number of audits completed, but it means within that type of income bracket, that was the percentage of those types of returns that were selected. So one thing to kind of touch on here that's really been interesting in recent times is that there's been a lot of controversy of the IRS selecting lower income taxpayers for audit for the earned income credit. The IRS does see a significant issue with those types of that credit being filed improperly and being claimed where it shouldn't be. So in general, there are a substantial amount of those that qualify for that earned income tax credit that are audited. And one thing that is has kind of been discussed that's unfortunate with that is these taxpayers really need their refunds. They, those that are eligible for the credit have claimed it because, they should qualify and they need the refund. They need that cash flow for their family. So unfortunately, right now with audits being so delayed, they're having to sit there and wait for months and months to even get a response to, okay, I provided the information you requested in order to have this credit claimed and to prove to you that I'm eligible. But the IRS is so backlogged, they're not hearing back for months, and it's putting a pause on the refund. So I'd say my point with that is that this table can be a little bit deceiving in the sense that if you don't understand it's based off of that income category percentage, it can be a little confusing. So just keep that in mind as we go through. But as you can see, as far as an income category that's most heavily audited, income over $10 million is at 14.52% compared to your lowest tax bracket, 1 to 25,000, which is at 0.71%. And we'll kind of go through a little bit more in detail these considerations about, okay, why are these audited more than the other? But in general, you can say that the more money you have, the more likely you are to be audited. There are several different types of audits. The range of these is significantly different between one. You'll see here on the table, automated under reporter. That type of audit is referring to when a taxpayer files their return, the IRS has third-party reportings of their income, 1099s, W-2s, that third-party verification of what was issued to a certain taxpayer in any given year, right? So what an automated underreporter notice represents is tax returns filed. It goes into the system and is processed, and something doesn't match up with what the IRS has on file, and they're showing essentially more income in their records than what the taxpayer reported on their tax return. And that does trigger an automatic notice and is sent out to the taxpayer and gives them typically a 30-day window where they're able to respond to a proposed assessment. It's not saying you owe this much, but it's saying we, the IRS, have records that don't match up with yours. We're proposing that you actually owe this much more in tax liability, and respond, or they progress forward with those. And I will harp on this throughout this conversation today. But the key to any of these situations is pay attention to those deadlines. The IRS uses those deadlines as an advantage for them. At the end of the day, the taxpayer is required to be able to defend what they've reported on their tax return. The burden of proof is on them. So if there's no communication and no response to these notices the IRS is sending out, then eventually through processes, that amount will be assessed if the taxpayer doesn't take advantage of their rights and meet those deadlines that the IRS provides. So that is the scary thing. Automated underreporter notice can be sent out to a client and they don't get it, they don't see it, and then finally the next thing you know, they're getting notices that they owe a balance to the IRS, and they come to you and they're in panic. And at that point, it's going to be much more difficult to get things addressed and corrected if there is some sort of explanation for that discrepancy. For instance, a lot of times we've seen clients who failed to put certain stock sale information on their tax return, and the IRS comes back with an underreporting notice and says you owe $11,000, and what they're reporting, the IRS on their end, is strictly just stock sales. But as we know, as tax preparers and accountants, you you have a basis typically in any stock that you purchase. So it's on the taxpayer to come back and say, yes, I had those stock sales, but here is the basis, and so I shouldn't be taxed on that full amount. So that's just one example of the automated underreporting system with the IRS. The next situation that you'll see, automated substitute for return. One thing that people, clients typically don't understand is that if you don't file a tax return, the IRS will file one for you based off of what they have on their records. So if someone received a 1099 for $100,000 in 2018 and doesn't file for any given reason, the IRS can go in, issue that 1099, or issue a substitute for return that they prepared from their records. No expenses claimed. Obviously, the least advantageous, using not filing jointly, not head of household. If you qualify, it's going to be filing single. And it's on the taxpayer to come back and make sure that any expenses that they want to claim on that return are going to be credited towards them to benefit them in reducing that tax liability. So that's another thing that can be automatically generated, is that substitute for return. If the IRS sends the client notices, hey, we haven't received your 2018 tax return, and time goes by, they will go ahead and prepare that return and then start collecting on the balance if you don't respond to those notices. So very important things to keep in mind that can just happen with, sometimes clients not even realizing it. The more common examination that we'll talk about, a couple of those more so here in just a minute, but correspondence examinations, those are IRS audits that are strictly via mail. There's really no person that you can contact directly. It's just all via correspondence, what us as representatives have to provide to back up what's on the tax return. It's all done via mail. And then of course we have the field examinations, which is whenever you have the actual IRS meeting, revenue agent meeting with you directly, or sometimes in office visits with the tax compliance officer. We'll go over all of these things here in just a minute. But this table just kind of represents what revenue really is coming from the different types of audits that the IRS handles. Certain things that can trigger an audit. This is something that we get asked very frequently because everybody's wondering, okay, what am I doing that could hinder me from being able to, I guess, going through this long process of an audit. Nobody wants to deal with that. I mean, we see audits taking a long, long time, especially right now with things being backlogged. So things to consider: missing income, higher income. We kind of already touched on that with the automated underreporting notices, that if they didn't report on their income on there, it's going to be something the IRS is going to come back and inquire about. Taking higher than average deductions or credits, that's going to be that industry standard that I mentioned previously, where the IRS for each type of industry has their standards that they see really the average of what that industry typically deducts for certain categories of expenses. And so that can definitely trigger it if your expenses are higher. Certain deductions are higher. Taking larger charitable contributions than most, that is something that they can easily, typically via correspondence examination, have you verify and show proof of those contributions. Schedule C reporting, that is an area that several clients, we have these discussions with them about the benefits of their tax structure as a whole, but one thing to keep in mind is that a Schedule C is going to be much a higher likeliness of being audited than some other types of business structures on the tax end, such as 1065s or 1120S S corporations, Schedule Cs, for whatever reason, the IRS is seeing that there's a likelihood that deductions could be incorrect on Schedule Cs, and so they've kind of triggered that to be something that's audited more often. Claiming rental losses, especially when claiming real estate professional. And that's something that, as a tax professional, we know that there are limits to what you can claim for passive income. You have to have, or passive losses rather, you have to have some passive income to offset that. And also there's certainly income limitations there for if you're eligible to actually report those rental losses. But I noted here the real estate professional is one of the bigger things that they look at. There's a significant amount of requirements that you have to meet if you're going to claim real estate professional to get around those other limitations. And you really, the 750 hours, there's guidelines that do have to be met. And, I've seen it whenever a client comes in and I'm like, okay, so you claimed this as a real estate professional and took the loss, but how many hours do you work on this activity? And like, oh, maybe 5 hours a month. Yeah, that's not going to cut it, unfortunately, from the IRS, and they're very particular about who can fall into the real estate professional window. So that's certainly one thing whenever we see clients come in with rental losses that we want to kind of check that box. Okay, are they doing this correctly? Writing off a loss for a hobby. This is something that we'll see in our case study a little bit here shortly, but hobbies are something that they have changed recently with not allowing losses for any type of hobby activity. And with that means, sometimes people have a hard time wrapping their minds around, okay, well, I had this income, but I have expenses associated with it. But unfortunately, unless you can show a profit motive and claim it as a business, at this juncture, the IRS is just completely disallowing the hobby, a hobby loss. You should never really see. That's never going to be something that the IRS allows as far as the ability to claim a loss on a hobby. Seen it before, claimed on somebody's return incidentally, and it was a discussion that we needed to have and did. Deducting business meals, travel, and entertainment. If there's a significant amount of that, that can be a trigger for the IRS, especially on a Schedule C, to come back and take a closer look at that. Obviously, we know right now with the Tax Cuts and Jobs Act that entertainment has been disallowed. So that's something that if you meet with a potential client or a new client and they've done their return last year and you see entertainment claimed, we all know that that's going to be a trigger to the IRS. Claiming 100% business use of vehicle, definitely the record keeping in regards to that has to be very specific to be able to prove to the IRS, yes, this was definitely 100% used for business and not used personally. And always encouraging business clients to keep a log of their business personal use is beneficial to them in the fact that it could be 3 years down the road and they're selected for an audit and they have no idea how to even come up with that information. Some others I just wanted to touch on: claiming the American Opportunity Credit. There's income limitations to that would trigger an IRS audit. Income or incorrectly reporting the health premium tax credit, claiming the home office deduction. You can kind of take a look here at some of those things that could trigger it. Operating a marijuana business, we've seen this a lot in our firm, having clients in the cannabis industry. I mean, the IRS has essentially said it's not a matter of if they're going to be audited, it's just a matter of when they're going to be audited due to the additional restrictions with 280E and the complexities that come along with that. Failing to report a foreign bank account, that's certainly one thing that we've seen a lot. In people not realizing, hey, if you have an account out of this country that's has over $10,000 at any given time during the year, you do have a requirement to file with the IRS and report that. I know that we at this point have had that question, in our checklist that we have clients fill out, but sometimes they still miss that. So it's certainly something to keep an eye out for and make sure to advise them whenever those things come up. There's severe penalties for failing to do that, and obviously none of us want our clients to be harmed in having significant consequences for that. Nice, neat round numbers. I think that's something that anyone who's prepared a tax return gets a report from a client of their income and expenses and sees those nice, neat round numbers. And it does look a little suspicious and requires a little bit more inquiry. So one thing to note, we kind of went over some of the triggers of an audit, but now I want to kind of dig into how does the audit process work? One thing that is important to know, you need to be prepared. There's a lot of time, effort, and that goes into those audits, and knowing the rights that a taxpayer has with the process is important. The IRS will contact your client via mail, not by phone, even though we see a lot of scary scam situations going on recently. They're not going to call you. The first correspondence will be by mail. And they'll give you a specific deadline date. And I will harp on this again for the second time. Do not miss a deadline. That's the most important thing that is unfortunate to see after the fact, is when a client comes in after it's too late, essentially, to do the processes that are going to be most beneficial as far as appeals. And I can't harp enough on making sure that you are expressing to your clients the significance of those deadline dates. Don't expect a quick process, and it is the taxpayer's responsibility to prove what they reported on their tax return. The IRS is there to audit you and try to assess tax, and that's going to be what they are specifically there in that audit to do, is try to see how they can assess tax due to a taxpayer. So documentation, I know we all harp so much with our clients, please, document, but this is where it becomes even more important. If you show up to an IRS examination with clean records, if you have a business, you have books that are very clean and neat, and they just have to go through and kind of select things, it definitely makes it less likely that they're going to dig in more and open things up more if you're able to show a very responsible situation as far as tracking. How long do audits take? We've seen such a range right now. It's been years. I mean, the one that we just completed was over several years that it went on, and it was going through each process that we had to take advantage of for the client. But typically, the more complicated the business, the more involved it is. If a client has several businesses, the longer it's going to take. The burden of proof is on the taxpayer, and I think that's one thing that we always try to express to our clients with audits, and honestly, a reason why I love it whenever we get to step in and help the client, because they can become so emotionally attached to the situation because they know for a fact, yes, I have these expenses, and sometimes fail to understand that the IRS auditor is there just to do their job, which is to make sure you have the proof and of the deductions, statements that show for deductions claimed. And I would say that's one thing that I would encourage everyone to express to their client is that at the end of the day, as they file their tax returns, they're supposed to have that backup and be able to prove it. And so the IRS agent is not there to do anything but their job, which is to get the proof of what you claimed on your tax return. And it's a very stressful process. But here, as I reference, this is something where if you can provide the information, receipts where you incurred the expenses and you keep adequate records to prove your expenses as evidence to support your statements on the tax return, with documentary evidence such as receipts, canceled checks, bills. These are all things that having third-party verification is ideal, if it's on a bank account, and then, with meals and entertainment, specific categories like that, the IRS is technically looking for receipts that have the name of who was there, what the business purpose was, who all was involved, the certain guidelines that the Internal Revenue Code list for these expensive clients have their minds do not grasp that. They have no idea. And so it is our responsibility to really make sure that they understand if they're going to claim these things, there's certain requirements they have to meet. So generally, the burden of proof is on the taxpayer to show that they did in fact incur those expenses. How do you know a client is being audited? You will receive, like we mentioned, I just mentioned previously, the audit notification letter. That's how they initiate the audit process, is by sending that letter to the taxpayer, letting them know they've been selected for an examination and providing them the date that they need to respond by or be available for, and that communication is really important to respond. It'll show the reasons the return was selected for an audit with, a deadline to respond. So again, deadlines, very important to keep an eye on those and make sure, even if it's a matter of responding via mail or phone, that you need more time, that's important. It's imperative that you meet those deadlines. The initial audit letter is typically accompanied by an information document request. So we call it an IDR. And that's where the IRS is going to specifically list out what information they are looking for, whether it's bank statements, which usually in any type of examination, they're going to ask for bank statements so that they can do a deposit analysis. Whether it's verification of a mileage log, whatever it is, it's in the IDR. It's important that people pay attention to that. If they don't understand something that's being requested in the IDR, that they really ask the contact at the IRS to give them more detail. Like I said, the IRS usually requests the personal and business bank statements for the audit year that they're reviewing, with records related to any business to the taxpayer that they operated in that year. It kind of gives them hey, these are the things we need in every audit. It doesn't mean that the IRS will not request more information later on, but that initial IDR is going to be the things that they ask for in any type of audit. We kind of went over the types of audits generally, with automated underreporting, automated substitute per return, and then this is kind of detailing specifically those audits that aren't automated, what types of audits are there. We touched on the correspondence audit, the in-office audit, and the field audit. And the initial audit letter is your key to determining the type of audit and the issues under examination. So the first type is the correspondence audit. These are really the least intrusive type of audit because they're just via mail. typically the scope of the audit is going to be more limited than if you were doing, selected for a full in-office audit or field examination. The audit letter is issued with an IRS service center. There's no specific auditor assigned, which honestly can be really frustrating. You have the benefit with the correspondence audit of, yes, this is more limited in scope typically. However, you don't have a specific contact. So when you call in, they're just going to tell you, hey, I made a note on the account and, advise you to typically send a letter and have that documented that way. But you can't just call in and talk to the person selected to do this audit at the IRS. It's strictly a back and forth via mail mainly. The letter gives you 30 days to respond. Typical issues include unreported income or deduction that is not on record at the IRS. Like I said, the scope is typically more limited, and documents are submitted via fax or mail. You don't have a formal meeting like you do in those in-office or field examinations. You can request extra time if needed. And generally the IRS, from what we've seen, will only grant that extension once with these correspondence examinations. From my perspective, just seeing and hearing what I've heard, the IRS utilizes these correspondence audits as a quick way. They want this process to be quicker than what we typically see in an in-office or field examination. So they're not going to grant you as many opportunities for more time to gather information. This is just kind of an example of the initial letter, but you'll see the person to contact is limited as tax examiner. So that's one of the things that you want to take a look at whenever a client sends you a notice that they've received from an audit, and the IRS regarding an audit. If it says tax examiner and not a specific person with one of the other terms that we'll go over here in just a minute for the other types of audits, that's a correspondence exam. And it's just going to request that you send in documentation. The office audit. So office audits usually involve less complex tax returns and are audited at an IRS office during a scheduled appointment. And you're going to see that the letter is issued from a tax compliance officer, which a revenue agent is going to be assigned to those more involved audits that are not just going to be expected to be one meeting. A tax compliance officer is somebody who's going to be assigned to an in-office audit. Communication with the auditor is conducted via phone and in the tax compliance officer's office. These individuals at the IRS are not permitted to travel, so you have to go to them for the meeting at the location that they're at, and the auditor will expect all documentation to be provided at the audit meeting. Their goal is that you have everything there that they've requested in that initial IDR, information document request, and that way it can be efficient and have a quicker completion date. The goal of an office audit is to have only one meeting with the auditor, and you will want to have all substantiating documents organized by whatever issues that they brought up and be able to explain each document in that meeting. Typically, we've seen it take up to 4 hours or more. Not to say that there may not be a follow-up meeting scheduled, but they have high expectations of you being fully prepared to go over all the issues. So ideally, if you don't feel like you're going to be ready for all of those issues to be discussed in that meeting that is already scheduled, contacting them and saying if maybe you can push it out a few days just to where you're very much more prepared. They want you to be prepared in those meetings, so sometimes they will be flexible. So the office audit, the initial letter, hence that it is an office audit by basically it has the auditor asking for you to come to him or her. And again, that's a tax compliance officer. So you won't see that tax examiner title there. You're going to see tax compliance officer if it's an in-office audit. The field audit is the most comprehensive of the 3 types of audits, and they are assigned what's called a revenue agent with the IRS. The audit typically involves the agent's request for an in-person interview, and in the case of a business owner, sometimes a tour of the business, depending. As the process unfolds, the auditor will typically request additional documents, issuing follow-up information document requests that address specific deductions or other questionable items on the tax return. Most revenue agents or RAs allow approximately 15 days to respond to an IDR request. If more time is needed, you've got to ask for it. So again, I think with the field audit, it becomes even more imperative that you stay, keep that line of communication very open, because they are submitting, giving you different IDR requests on a consistent basis, depending on what they find from each different one. So if you do need more time to gather the documentation, definitely stay in communication with the revenue agent and ask for it. Revenue agents have more training than your tax compliance officer or your tax examiner. Typically, a tax examiner is trained on the specific items that they usually audit, which is anything from charitable contributions to like on a Schedule C, mileage, car and truck expenses, or other kind of key areas. They're kind of limited in their scope and their training. A tax compliance officer has a little bit more training and go a little bit deeper into audits as a whole, but a revenue agent usually has a full comprehensive knowledge of tax returns, the accounting that goes behind it, significantly more training than your other two types of employees at the IRS. So since they're more knowledgeable, I mean, the reason why is because this is supposed to be more in depth of an audit. The field audit, the initial letter hints that it is a field audit by the term revenue agent being listed. So it's going to be coming from a specific person that's requested to schedule this meeting, and it's going to say revenue agent. That's your hint that it's going to be a field audit. It's going to be significantly more involved than your typical correspondence examination with the tax examiner or your in-office audit with the tax compliance officer. A CP 2000 is the notice that will get sent out whenever the records with the IRS are not matching what a taxpayer files, and they're proposing a change and an additional assessment to the tax period. So for instance, like I was talking about, a client who doesn't report their stock sales, and the IRS comes back and says, hey, we're proposing this is additional amounts owed. That is the CP 2000 letter that they're going to receive. It feels like an audit, but the IRS is just wanting really to explain there's a mismatch in their system between your return and what was reported to the IRS. And it includes that proposed adjustment, and it's going to give you 30 days from the date of the letter to respond, or the IRS presumes the changes are correct and will move forward to assess the additional tax. So never ignore CP 2000, 30 days. Very important that you communicate with the IRS within that time frame, even if it is to ask for more time and an extension to review. If you disagree with the CP 2000, you'll need to provide documentation to support the disagreement and return the CP 2000 within the 30-day time period. Stay on top of that 30 days if you can. Clients need to understand that they need to get that documentation as soon as possible so that you can meet that deadline. So the initial audit letter, the takeaway from all of this and me talking about the letters is that there is a wealth of knowledge in those letters that they send out. The first page of the initial letter provides you with a lot of important information. You can know, this is just kind of an example letter, but from this letter, we can tell the taxpayers 2015 Form 1040 is under examination. The name of the auditor assigned indicating that it is not a correspondence audit. So it has a name and it doesn't say tax examiner only. So we know that it's not a correspondence audit. And then there's a specific response deadline. So those are the important things we can see from a notice like this that your clients will get in the mail. What documents do you need? gonna introduce this information document request again because it is so important that you understand what exactly that means. It's attached to the initial audit letter. Like I said, they start with the basics of what they typically need in an audit with the first IDR. And that doesn't mean that there won't be subsequent IDRs. And sometimes there's several subsequent IDRs depending on how the audit goes. One tip that I have for you is always request a copy of the tax returns under examination from your client, in addition to the documents requested from the auditor. You want to have a good grasp of what was going on that tax return, and you may even see things reviewing that tax return that could be off, and maybe prepare the client that this hasn't come up yet. We're hoping it doesn't come up. One thing I will say is only give the IRS what they request. Don't ever give more than they ask for. You're not required to. So as they're going through their process, they're looking for whether they need to look into anything further, what other expense items they need to audit specifically. So if they ask you a question, answer the question, stick to answering that specific question. You don't need to go providing them more than they've asked for, because then that can lead to them reviewing something that just makes the audit progress on longer than it needs to. So stick to answering the questions that are asked of you. This is just an example of an information document request, which is really nice to see because you can just kind of get an idea of what those look like generally. You'll see here that they list out the different things that they're requesting, but also give a little bit of detail as to why they're requesting those things. So that's just there for your reference to kind of take a look at any point if you want to look at it further. So what happens at the initial meeting? The auditor will ask a series of questions about the taxpayer in that initial meeting. And these questions, they don't provide in advance of the meeting that you have with them. They are generally the same with each taxpayer. So, for instance, in our firm, we've become pretty familiar with what they ask in an audit. We've been doing this for years. We represent several clients on a yearly basis in front of the IRS. So we have kind of our own checklist that we go ahead and have clients answer for us, so we know it up front. But keep in mind, again, only answer what the IRS asks. You don't have to do anything other than that. So even if you gather more information from your client, the only questions you need to answer are the ones that the IRS asks you in particular. So really, as you're starting this, I would just say learn as much as possible about the client as you can, what type of income they earn, what type of assets they own, and take those answers and that information with you to the meeting, but do not give the auditor a copy of those answers. Again, as they ask the questions, reference your questionnaire as needed, but just provide the answer. Do not give them some novel of the ins and outs of your client's income and expenses, because you don't want to, have things that you trigger that really aren't necessary in the audit meeting. Our responsibility is just to answer the questions. This is just kind of a tip. When in doubt, always consult the IRM, the Internal Revenue Manual. It instructs service employees how to conduct their audit, and standard auditing techniques are given in that outline. So if you're ever curious as to, okay, this client was selected for an examination from the IRS, what are things that I might see, or what's that process going to look like? That's always a good reference if you want to see what technically they do in a typical situation, what they're allowed to do. Audit goals, I have 5 things listed here. Control. You want to control the flow of the information to the IRS. That's one goal. And like I said, you just answer the questions, give them the information requested. You don't have to do any more than that. Try to limit the scope and duration of the examination. Learn, be prepared on the questions that are going to be asked and learn about your client, what kind of business they have. Do they keep good records? Do they commingle funds? Is what's listed on the return accurate? I mean, things that you need to know kind of going into that. One thing I would say, the IRS is always going to do, they will do a deposit analysis for when they get the bank statements for business and personal. So things like knowing whether if a client had a loan they received in a year, and that may show up as a deposit to the IRS, but it's a loan, or maybe it's a gift, or whatever it may be coming into their bank account. Those are things that it's good to just know up front. You don't have to say anything about it until they ask, but asking your client, hey, did you have any loans that you received that could have been deposited into your bank accounts? Or, if you do the accounting for them, you may already have a good grasp on that. So keep a complete file of all documents given to the service. So have clear reference for what you've provided them so you can go back and refer to it, and know your limits. If an auditor mentions the IRS is pursuing criminal charges, advise your client to obtain representation. That's one thing. Doing this for several years, I haven't seen it very often, but we have seen it where the criminal side of the IRS comes in and it's something that becomes way more serious. You're not just looking at some penalties at that point, consequences of penalties and interest. It's more than that. And I would advise if anything starts to head that direction in an examination for one of your clients, that you encourage them and let them know that you can help with kind of that audit piece, but it's not something that, as far as the criminal side, you're going to represent them on if that's something that you don't do. An audit can conclude in 3 ways. One is a no change. So no change audit, which they were able to confirm everything you put in your tax return and no issues there. The agreed is whenever they have maybe found some proposed changes, but you understand them and you agree with them. And then finally, disagree. That's whenever the IRS proposed changes that you want to make sure that they understand you don't agree with. So no changes, very rare. I've seen those a few times. Typically, there's something one way or the other. So kind of going into knowing your rights on options if you don't agree. There are appeals rights, there's tax court, and there's audit reconsiderations if you don't agree with your results of the audit. So you can proceed with appealing the audit results in either of the following ways. You can request a conference with the examiner's direct manager. You can request a fast track mediation, or you can file a protest letter to begin the appeals process. This is typically something, one thing to know with revenue agents, the initial person assigned, even like a tax compliance officer for an in-office meeting that you have, they're limited a little bit on what they can do at their level. If you appeal to their manager into the appeals department overall, they have a little bit more flexibility to allow things that that initial auditor signed doesn't have the authority to allow. So we see it frequently where we do have to go into the appeals process. So with that, you'll receive a 30-day letter once the auditor finalizes their proposed changes. It's known as the letter 531, notifying you of your rights to appeal the proposed changes within 30 days. So again, one of those important deadlines, 30 days. That's a popular deadline that they give, is the 30-day window. So generally you have 30 days from the date of the letter to inform the auditor if you either accept the proposed changes or want to appeal them. If you need additional time, you can contact the auditor and request additional time. Appeals if you agree. So depending on the examiner, you as a representative will have the ability to sign the examination report or similar form depending upon the type of audit conducted. But this is important to note, is that once a report is agreed to, you can no longer fight that assessment. It does not matter if additional information becomes available at a later date. So once someone signs as agreed on an audit, it's done, it's final. There's no appealing it and saying, oh, wait, no, I didn't provide you this documentation. You have your chance with the appeals process to provide that additional information. Don't sign agreed unless it's 100% that the client and you understand that's going to be assessed and it's going to be paid however it's going to be paid. So one thing, if you disagree, you can proceed in either of the following ways we kind of mentioned. So I'm going to dig into those a little bit more. One thing that I had mentioned was the fast track mediation, when that's when the IRS created fast track. They created this program and it was really developed to try to speed up the process because audits were taking a long time. And it's essentially where you can, the appeals officers were getting backlogged too. So the fast track mediation kind of helps initiate a faster process. You fill out form 13369, and this can be done at any time during the examination process. And once it's accepted, the goal is to get a resolution within 40 days. And the normal average appeals process takes 293 days. So as you can see, the average there is a lot quicker for a fast track mediation, hence the name fast track mediation. An appeals officer will be assigned as the mediator on the case to assist in the negotiations at no cost to the taxpayer. Typically, the taxpayer or your representative will be present along with the appeals officer. So if you're representing this client, you would be in there with the appeals officer, the examiner, and the examiner's manager. One thing to note here is that the appeals officer is permitted to hold separate meetings with the parties in attempt to reach an IRS settlement. The appeals officer does not have the authority to accept an IRS settlement offer on the taxpayer's behalf or require the taxpayer to agree to the IRS settlement offer. So you still maintain full control over the decision, whether you want to agree to it or not. The appeals review of taxpayer, I'm going to kind of go over some of these things a little bit quickly, just due to time constraints, but you can always go back and reference this in the notes if you have any questions. We're happy to help. But the protest letter, this just kind of outlines specifically what you want to make sure is included in your protest letter. There's no specific guideline that the IRS provides us as representatives or the taxpayer of how they should appeal, but there's some key things that need to be included in there that they provide. So that formal protest has to be submitted. Needs the client's name, address, tax periods included in the audit, a copy of the 30-day letter that showed the proposed changes from the auditor, and then the following statements need to be included in that letter, which is your client wants to appeal the examiner's findings to the appeals office, the facts supporting your client's position on any contested factual issue, making sure that's clearly defined, and then the law or other authority upon which you're relying upon, and a declaration of under penalties of perjury attesting the statement of facts is true and accurate. Once that protest letter is submitted, it's approximately 60 days. You will get the introductory letter indicating, again, approximately, things are a little bit slow right now, but indicating the appeals officer has been assigned, and that's on letter 3808A. Typically, all appeals officers will conduct all hearings over the phone. If it is a local officer, you are able to request the hearing to be in person. So you can request it to be in person if you prefer. For local appeals officers, it is recommended to fax over any documentation at least 48 hours in advance of that phone call, just to give them time to review it. If you agree, the appeals officer will draft up settlement papers, if it's a partial agreement, whatever it may be. And if you disagree, a notice of deficiency will be issued. So if you petition tax court notice of deficiency come hand in hand. The notice of deficiency is the notice that a taxpayer or client receives whenever they haven't been able to come to an agreement through their audit. It allows them 90 days to petition tax court. Very important date. Once you miss it, there's nothing as far as that right to petition tax court that you can go back and get. So please note, if you petition tax court, you will not be provided another opportunity to hold another appeals hearing. You're only provided one opportunity to resolve the case with an appeals officer. So kind of just going into tax court, a notice of deficiency, like I said, will give you 90 days to petition. So this is after appeals, after you've gone through that process and still haven't been able to agree on the issues at hand. You can petition tax court, and this is the lengthiest option for resolving the matter. We're seeing at least 6 months to be called for trial, at least. So it's not going to be a quick process. 90% of tax court cases reach a settlement before even going to trial. So there's still that motivation for the IRS, since they only see so many they only select so many cases for tax court in any given year. They are very motivated to try to settle outside of that. So whenever counsel is assigned, you have that opportunity to work back and forth with them on the client's issue to try to settle it prior to trial. An audit reconsideration, I noted this here because it is an option if, say, a client no longer has tax court rights under a notice of deficiency. You can request the IRS open up an audit, and basically it's at their discretion, an audit reconsideration. You're saying, hey, this was the results of my audit, and I actually have more information, and the more details you can provide in that audit reconsideration request, the better. It is another option. The thing that it makes me hesitant about it, and the really big con, is that the IRS collections process still proceeds even during this time frame. So this is something that, you know, both departments don't really communicate very well at all. They don't communicate. So if there's a proposed assessment out there, you still have the collections department moving forward on that, and it can be something that could be a consequence for the client. In order to request an audit reconsideration, the taxpayer must have filed the tax return, and this just kind of lists certain items, the criteria that have to be met in order for you to file an audit reconsideration. We're seeing those. I mean, it could be up to 2 years before this is actually opened up and assigned to somebody. So it's not a quick process either. This just outlines particularly the items that IRS reasons, I guess you should say, why the IRS will not accept an audit reconsideration. Another avenue for, you know, if there's not that appeals process opened up anymore, if you've lost those rights, or the tax court petitions, you know, rights are remaining there, an offer in compromise, and specifically for status to liability, is another way to kind of go through the process of proving that you do not owe a balance, and providing documentation to prove that you don't. And the one thing that's a positive here is that if you file an offer, typically there is a hold put on collections, so it can help avoid the consequences of the collections side still moving forward and collecting on your client. This just has 9 steps listed for you to reference of the acceptance, kind of giving you details of how to prepare that and what that process looks like overall for status to liability. We already kind of touched on 6020Bs, the substitute for returns, and how the IRS can automatically file for a client or taxpayer. So I won't go into detail too much on that, and I'll just kind of jump into a quick overview of our case study. So we had a client that we represented with the IRS, and they had several businesses. So kind of facts of the matter: construction business, a spray foam business, an oil business, oil and gas company, car accessories business, and a farm. And their initial audit results for tax period 2017 was proposed assessment of $422,000, and tax period for 2018, $739,338. In this situation, it was the one good thing I will say is that yes, it was a scary balance due when the client came to us to ask us to represent them, but we still had appeals rights, which was huge. And one thing I will say is that when a client comes to you and they're still in that initial stages of the audit, they still have all their rights available to them. That's a huge win because you have the opportunity to utilize the processes that the IRS provides to fight for that client. If they've already been proposed and the notice of deficiency had already been issued and the 90 days was passed, it's unfortunately a completely different circumstance. So this was a win in that we still had appeals rights. The main issues, hobby, the IRS was saying that 3 of the 5 businesses were hobbies and not for-profit entities. So they were making this client report all income, but not allow them to claim any expenses. So that was a significant chunk of this balance due. Depreciation, as you can see, for 2 years, they had a lack of substantiation through the audit process so far up to this point. And then car and truck expenses, lack of substantiation. The client had 1099s that hadn't been filed, so the IRS was just allowing $350,000 of contract labor that was reported. Farm losses, they were moving to startup costs and saying that the farm hadn't started in that year. And then there was unreported income that they showed after the deposit analysis of bank statements of $200,000 that they added to income. There was additionally a net operating loss coming through from an amended 2016 tax return that a previous accountant had prepared for them. And the IRS had already rejected the amendment, and they were disallowing that net operating loss on 17 coming through from the 16 amendment. Where did the taxpayer go wrong? They missed deadlines. They were unorganized with their documentation. They had several Schedule Cs being reported on the tax return, which, as we mentioned earlier, it is one of the highest types of business structures as far as tax filings are concerned, that it has the highest audit rate. And they had a lack of proper record keeping for car and truck expenses. They didn't file the 1099s. They did not have detailed bookkeeping to verify loans and transfers in and out of between businesses. So that $200,000 was being assessed and commingling. The results, though, after approximately 13 months from when our firm got involved, after utilizing the appeals process, did not have to petition tax court. Fortunately, the client, was in agreement with the appeals process and the results of that, but we have provided 633 pages of documentation to the appeals officer, including itemizations of specific expense items that the IRS had requested. The original balance for 2017 was $422,000. After the appeals, it was $82,000. The only thing left was the net operating loss and some depreciation that was disallowed. And 18, same thing. Basically, overall, they started from where they started. It was total savings of $958,000, and that's huge. I mean, we're talking about almost $1 million of savings. I mean, with penalties and interest, it would have been in excess of that amount. And the key things to note here are that the client got to us in time where we could utilize the appeals process and guide them on what documentation they needed to provide, the purchase documentation for the assets that they had listed, the information on any loans or transfers over from other businesses that were coming into the bank account so that they weren't double taxed on those transactions. Those are just a couple of examples. The hobby losses, that's one big topic. That was a huge one on our part because they were trying to say, the spray foam business and a couple of these other entities were hobbies. However, we were able to prove that the client had a very clear business plan, but there was certainly for-profit motive there. And, he did have separate books in this company, between companies. They weren't necessarily all clean, but he was tracking them separately, had separate bank accounts, had several of those things that you look at when trying to argue a for-profit motive that we were able to, push through and get allowed for the client. So a huge win, but as you can see, the opportunity for savings is significant, but it's a long process, 13 months that it took for us to get through from the time we entered into it. Of course, the audit had already been going on when they hired us. So that means it was longer than 13 months for the audit as a whole. That's just from the point that we stepped in and were able to go through that appeals process. So in summary, just from things that we've learned today and that I've shared, the more money, generally, the higher chance of your audit being selected for an audit. There are several different types of IRS audits that we went over today, from correspondence exams and office audits to automated underreporting notices. There's certain things that can trigger an audit. We went over several examples of that. And just generally, you need to be prepared to have the documentation in hand and organized whenever you're representing a client in one of these examinations. The cleaner you come into that with the paperwork to that examination, the better off you're going to be. If you're kind of scrambling for things, it not only makes the auditor question whether that client has adequate records, but it also just frustrates them. So, at the end of the day, those auditors are human, and the more pleasant you can make the experience for them, typically the better result you're going to have. So those are kind of the key things that I wanted to share today. Like I said, we have references. If you have any questions, of course, we're happy to answer them, but I've kind of gone a little bit long already, so I think I'll end there. Again, I appreciate you all having me, and if there's anything that you need as far as questions, let us know.